The Morgan Report with David Morgan.
David Morgan with you with the weekly perspective for the week ending 19 June 2020. Well, let me start with the stock market, even though we're looking at unemployment, and I'll get to it in a moment. But just, I'd like to say that Decision Point, which is, I think, one of the better services out there, talked about their price momentum oscillator, and basically they have a sell. Even on the NASDAQ, which is making new highs, it takes into account several indicators, and they're leading indicators on a short-term basis. And you can look at candlesticks and everything else to integrate. But the point I'm making is we've had one heck of a rally into the stock market. It was in a confirmed uptrend. I do think that we've probably overdone it for a while, so I would say neutral the stock market personally. And I want to let you know I got verification from Decision Point. So that's it with the stock market. Let's move on to some of the leading articles this week. First one up is from Mishtalk. Continuing unemployment claims tell a bleak story. You can see from the chart here that from the CV situation, we went to a high, according to this chart, of about 25 million. Unemployment has dropped all the way down to 20 million. These are just huge numbers. Look at the unemployment claims on this next graph, and of course it's a straight up shot, and we all know why. But I mean, these are situations where I think 20 years of new employment has been wiped out times two in this current crisis. So really a lot of jobs lost, and some will come back. I get that, but a lot won't. And you can see this one, the initial unemployment claims in 2020, how it shot up immediately and is tapering off, but there's still additive, as that previous chart shows. So unemployment high, not just in the U.S., across the globe, and we do have to keep our eye on it. It is a huge impact to families and businesses on the aggregate, on everything. From Zero Hedge. In latest liquidity flood, the European Central Bank counts at a record 1.3 trillion euros in negative yields on their TLTRO loans. So more of the same. It's not just the United States Federal Reserve that's pumping out funny money like unbelievable. It's basically across the board. And of course, this article focuses on the European Central Bank. And printing your way out of this mess is not going to work. It will work for a while. Keynesian economics does actually work for a while until it doesn't. And it's not going to. We are in a point of no return, and I've used the analogy several times of the backside of the power curve. No matter how much funny money they print, it's not going to stop the contraction in the economy, and eventually the currency crisis that myself and many have warned about, where the currency starts to be distrusted in the marketplace. And once you reach that point, you really can't get it back. So interesting times. Don't be fearful. There are ways to protect yourself, as you well know, and the adjustments are available to us all. We just are going to have to adjust to a new paradigm. Another article from Bloomberg, finance's addiction to dollars leaves the world vulnerable to the United States. And we all know this, but I think it was interesting. This is just one day ago article. The U.S. dollar's growing dominance in international finance means that American problems can quickly pose a threat to the entire world. That's one takeaway from a report by a committee for the Bank of International Settlements, which noted the greenback share as an international funding currency has grown to levels not seen since the early 2000s. Stresses in global funding markets earlier this year as the coronavirus began harming the United States economy highlighted how easily a dollar-related shock can spread. Well, it isn't just CV, folks. It's the funny money printing that I talk about every week, and the trust factor or the confidence in the markets in total. And we are losing that, even though the indexes may be higher, bigger numbers, the confidence level, and it's hard to measure, but overall it's declining. In fact, it's declining rather rapidly. Next up is from Casey Research. Here comes the U.S. digital dollar. I've been talking about this, especially in the paid subscription to the Morgan Report. This is going to happen as far as I'm concerned. There will be banks, money center banks, commercial banks, and of course the central banks or the national banks such as the Federal Reserve, the ECB, and others that will go to a digital currency. Things are digitized already, but what I mean by that is basically that's the only methodology. Cash will be wiped out. There'll be a cashless system. You have to be on a digital wallet, and this is something that this article talks about. Talks about Bitcoin versus the dollar, the digital dollar, I should say. So we're following this story. In fact, we've been writing about the blockchain and how it influences the financial system for months now. I think it's probably been for about 2 years. We include it in the Morgan Report every issue. I try to touch on energy every week. This is from Wolf Richter, Wolf Street. Does great work. Haven't featured him for a while. This is a very good article, worth your probably 4 or 5 minutes. Read the whole thing this weekend. Update on the WTF collapse of demand for gasoline, jet fuel, and diesel. Demand for gasoline collapsed in a stunning historic manner. We all know that. And by the way, I'll repeat that energy is the most important commodity out there. And of course, for the most part, that means oil. And so he goes through it here, shows the drop off in gasoline consumption, shows the consumption on a weekly basis. And you can see it just fell off the map here. And of course, we all know why. With the CV, jet fuel, same thing. And you go into consumption again on a weekly basis. Distillate is for basically railroad engines, trucks, some cars, agricultural implements. Basically, it's a low-grade diesel, but it's used, and it's something that not a lot of people track. But he's showing that that also has fallen off. And then he shows the combined total here. And, of course, unprecedented, and we all know why, with the CV situation, and it will bounce back, but not to the levels that it once was, not for several years. I agree with his statement, because a lot of people are flying less and will continue to do so because they, are using Zoom for their meetings, or just have decided that it's just not worth the pain and agony to get aboard an airliner to go to an in-person meeting when most of the time a lot can be accomplished in a virtual meeting over the internet. Also, there'll be less jobs, so that's another factor. And of course, electric vehicles will play into it somewhat, but I don't count that probably as big a factor as Wolf perhaps does. It could have some impact, there's no doubt about it. But there's a lot of stay-at-home people now, and then that trend is going to continue to some degree. Yes, this will bounce back, but I think the energy sector is going to be a lot less demand than what it was, let's say, in January of this year, and I think that's going to be the case for quite some time. Well, before I move into the metals, which will be after this article, I'm not putting my tongue in my cheek too far, but it's almost fitting that the doom scenario gets published here by Market Watch. And this is the headline. There's a 1 in 3 chance of a massive disaster that could be worse than COVID-19, says Deutsche Bank. Well, I would say there's probably something to do with Deutsche Bank's failure that could be catastrophic. But let me just highlight the article. Basically, the analyst Henry Allen says there's a 1 in 3 chance that at least one of 4 major tail risks could occur within the next decade. A major influenza pandemic. Well, we kind of know about that one. Killing more than 2 million people. The next, globally catastrophic volcanic eruption. Well, okay. A major solar flare. This is sort of the kill shot from Major Ed Dames and others, or a global war. From my perspective, pandemic is kind of baked into the cake at this point. Look for round 2, 3, and 4. Global war, unfortunately, I would say that's probably the also most likely scenario. I'm not trying to paint doom, gloom. I'm just letting you know that even, this is Market Watch. This is pretty mainstream bringing up other possibilities of catastrophe. We've got enough on our hands without adding to them, but I thought I'd finish with that article and then move into the precious metals. Did a few interviews this week, as I do almost every week. This is from Weekly Market Wrap from Money Metals Exchange. You can go to the website, or if you're on our free email list, you'll be getting it this weekend or shortly thereafter, probably Saturday or Sunday. I did an interview on the supply crashing during the shutdowns, and you can go to the website now and listen to it. It's probably on our blog. Just go to themorganreport.com/blog. It's probably posted up there. Or you can go to Money Metals Exchange and hear that interview. Well, folks, let me start with gold. This is from Reuters. Title: Venezuela's rival presidents prepare to do battle over gold in London vaults. So the run to gold begins at the nation-state basis. Basically, what this article talks about is Nicolas Maduro says that his administration has the rights to the gold in London, and he claims to be the rightful leader. And of course, the court will be deciding who has the correct claim, where the opposition says that they have the rightful claim. And that's Juan Guaidó, who's the British government recognizes as the rightful leader. So, gold's important. Fiat isn't, although, well, it is to some degree until it fails. But regardless, it's interesting to see this article on Reuters. Let's see who gets the gold to Venezuela. Another from Reuters. World's ultra-wealthy go for gold amid stimulus bonanza. From Zurich and London, as stock markets roar back from the CV rout, advisors to the world's wealthy are urging them to hold more gold, questioning the strength of the rally and the long-term impact of global central banks' cash splurge. Read nonstop, unbelievable printing. Now some are channeling up to 10% of their clients' portfolio in the yellow metal as massive central bank stimulus reduces bond yields, making non-yielding gold more attractive and raises the risk of inflation that would devalue other assets and currencies. Well, where have we heard that before? This is from USA Gold. Goldman hikes 12-month gold price forecast to $2,000 an ounce. Some of you, probably most of you, are familiar that Bank of America has given a 3,000 target. I forget the time frame. I'll say a year or so. And it's pretty obvious even the major banks are saying gold's going higher, and it is. We are still in a consolidation period, an indecision pattern, and I still think we'll probably get a bit of a pullback, but it won't be a significant one. If you follow me over here on this right-hand chart, with a one-year chart, we're consolidating here around the 1750 level. And when we had the scare with the stock market, and it took gold and gold stocks down substantially for a brief period of time. Now they're right back up. Gold, not all the stocks. Some of the stocks are making new highs, but regardless, it was short-lived. Gold reestablished itself. And again, it's probably going to break this channel, probably to the upside, but I think you're going to test the low part of the channel or maybe break it to the downside briefly. Summer months are usually good for gold purchases because the strength in the gold price usually weakens during the summer months, and usually seasonality-wise, gold is its lowest point for the year in August in most cases. So next up is from Roland Manley from Bullion Star. I don't feature him probably enough. Very clear thinker. I like the way he writes and thinks. Talking about this curious case of COMEX gold deliveries in April and June. He goes through a lot of bullet points here about the decreasing liquidity of bullion banks, large losses at bullion banks like HSBC. I'll add Scotia says they're dropping out. Gold borrowing rates were rising from the March event onward for a while. Bullion banks are scrambling to secure gold to go to New York, and that was partially because of the airline travel shutdown in some instances. So that's kind of the rest of the story. The launch of 400-ounce contract, which is quite bewildering. Huge volumes of gold bar exports from Switzerland to New York. But I like what he says here. He gives you all those factors. They're all true. They're all factual. They can be verified. But he said because of the wholesale market being opaque, which opaque is a fancy word for you can't see it, you're basically on your own. He said that for those looking for a theory of everything framework to connect all of the above dots, you've got to do it on your own. And I like that because even though I'm well connected, I've talked to refiners. I knew about shipments coming from across the pond to New York were delayed or non-existent in some cases. It was hard to get it delivered over here, in other words. And that's a fact, believe it or not. But basically, no one's put it all together. And I like someone that's that truthful. While Bloomberg and Reuters are content to repeating the spoon-fed handouts about the above, eating the breadcrumbs instead of following the trail, and between them, they have published at least 30 articles on the subject. Thankfully, there have been many on the sidelines who are more inquiring and less gullible, hence the skepticism, speculation, and debate. So you can finish reading the article. Again, I like the way he thinks and writes. Talks more about the delivery cycle, gives an example here. Talks about, of course, that's from the CME. Talks about gold vault warrants. Again, getting back to something I've harped on over the years between the registered category and the eligible category. And then there's this very opaque, nobody really understands it. And I've talked to almost everybody that I know that knows something about this market on these exchange for physicals and what those things really mean. And I have yet to get a satisfactory answer what they really mean. And I'm telling it like it is. So great article, especially if you are heavily involved in this market or going to be so. I definitely say that this article from Nolan is worth the read. And I just want to finish with silver. This is from my friend Nick Laird. Gold charts are us. I definitely, anyone that's chart oriented or really wants to see a lot of great data, I recommend you get a subscription. It's not that expensive. I forget, I've been a subscriber for years. And I'm showing silver depositories, ETFs, funds, and e-funds. So what I want to point out here is what you already know. This line item here, we're looking at the SLV. And on the SLV, this is a 4-week change. So here's the change. I kind of drew through it, but the change is round numbers 30 million ounces over the last month going into the SLV. So keep it up. We will get all those commercial bars put away for investment purposes, which will continue to put price pressure on the silver market. The next best increase as far as percentage basis is the ETF PHAG, and you can see that that's been 4.7 million ounces, or an increase of about 4.16%. You can read down all of them. The Zurich Continental Bank. Had the pleasure of meeting one of their top analysts there years ago. Their increase by 2.6%. So you get the general idea here. You can see that the registered category, which is the dealer inventory on the COMEX, decreased in this 4-week period by 5.474 million ounces. It didn't come out of the eligible. In fact, the eligible went up, which really means that long-term silver investors are just storing in COMEX-approved warehouses. That's really what it means. So that's it. Still bullish on silver. We're still in a price channel for both metals. The ratio is still roughly 100 to 1, which is better than the 125 to 1 it was not that long ago, but a lot of room to the upside for both these metals. I'll leave it at that. Remember to, please, if you like any of these videos, if you would mind passing them on to friends, families, your social media, whatever, it certainly helps. I do the lot for free and fun, but sometimes I just like to get a little more of the word spread out. And I'll finish, as I usually do, with there is nothing more powerful than the truth, and the time has certainly come for all of us to be true to ourselves, to speak the truth to power and our families. And even if we disagree, let's just try to be adults. We don't have to agree on everything. That's what really makes the world such a magical place is that we get to contemplate and think about and explore new ideas, new ways of looking at things, vectors and tangents of something that we think we know about or can still learn more, and on it goes. The human experience is really to be savored, not to get in an argument at the drop of a hat. You do a lot more by learning, by listening than talking. So that will conclude it for this week. I will be back with you next week for another edition of the Weekly Perspective.